In July of 2019, Elizabeth Warren said this.
Yeah, you know why Shopko's closed? Private equity. Anyone remember Sears? Yeah, Sears, private equity. Toys R Us, Gymboree, and it's not just the retailers.
Her argument is that private equity is to blame for the closing of some of the biggest household name retailers: Shopko, Toys R Us, Sears, and Gymboree. Whether or not this is just strategic messaging for her presidential campaign, or if she genuinely believes it, her claims deserve a deeper look. What is private equity? How does private equity make money? And are they responsible for these retailers going bankrupt? You're watching a Compounded Daily video. If you like this video, subscribe to our channel and hit that notification bell. When you think of Wall Street, you think of big banks, hedge funds, trading floors, and maybe Gordon Gekko or Jordan Belfort. But the chance that you have heard about private equity if you are unfamiliar with finance is pretty slim. And there is a reason for that. If you are not in the center of a global economic crisis, crafting ways to get large returns, or having insane parties in your office after a successful year, then it's likely that the media doesn't care about you, and private equity fits that box. The simplest way to describe private equity is the use of funds to purchase ownership in other companies. Much like buying stock on the stock market, private equity firms will buy a majority or minority stake in a private company. However, it's most likely that they will purchase a majority stake for one reason: control of decision making in the company. This is key, as private equity groups who purchase these companies have investors. And if they purchase a minority stake of the company, then the majority shareholders could implement poor leadership, and the money they invested in the company could be lost. The structure of private equity funds goes like this. They are usually structured as limited partnerships, with a general partner putting up a small minority of the capital invested, typically around 3%. The limited partners therefore contribute a majority of the capital, and the size of these buyout funds averages around $600 million to $800 million. In the past year, however, the average fund size has increased to almost $1 billion. That's right, these funds spend hundreds of millions if not billions to buy companies. Now, you're probably thinking that these investors are deep-pocketed individuals who have access to money that us regular people do not, right? Well, not exactly. Admittedly, some investors in these funds are wealthy individuals, but most of this money comes from pension funds, labor unions, university endowments, and other qualified investors. The reason why private equity funds are such an attractive investment opportunity is because of their rather high returns. It's common that private equity funds will beat the S&P 500, making it an attractive investment vehicle for those with the means to invest in them. Usually, these funds can return anywhere from 15 to 25%, but how they do so is what makes them so interesting. Imagine you are going to buy a house. You pay for 15% of it in a down payment, and the rest is paid through a mortgage. You don't plan on using this house, so you rent it out. And the amount you charge on rent is enough to pay the property tax, utilities, and the mortgage itself. So, what's the point? Well, you are effectively gaining ownership in the house at the expense of the lessee. When they pay rent, they are paying for you to own the house. The principle in private equity is the same. When these funds raise money, that money is typically only purchasing a part of the company they are trying to buy. You can think of it as a down payment fund, but usually 40 to 50% of it is paid for with the money the fund has raised. The rest is paid for using leverage, which is a fancy term for debt. And knowing that they mostly target profitable companies means that they could use some of the money that would have gone towards its profitability to pay down that debt. So if I were to buy a company that had $2 million in profits for the price of $10 million with $6 million in debt and $4 million in cash, then I could use that $2 million to pay down the $6 million in debt over 3 years. After I pay down that debt, I could sell the company for $10 million even if I did nothing to grow the company, and earn a $6 million profit. This is the idea of a leveraged buyout, and it's what helps these funds yield such high returns. Private equity does, in fact, actively try to grow the companies it purchases, allowing for it to sell the company for more than it purchased it to maximize its returns. They do this through two methods. The first is organic growth, such as marketing and hiring a sales team to expand the product's user base. Private equity groups will use their majority shareholder power to hire executives who they believe will operate the companies in a way to maximize the fund's return. The second method in growing these companies is buying similar companies through more leveraged buyouts. Let's say that Company A is a software company offering social media marketing tools, and the private equity ownership decides to buy Company B, which is similar size for the same price. For this example, $10 million. Assuming that Company A's debt has already been paid down, they borrow a new $5 million on Company A, and Company B borrows $5 million. All of this is borrowed money, allowing for the private equity groups to expand the size of these companies without spending a nickel out of their fund. They would then pay down the debt with the combined company's profitability, allowing them to effectively increase the value of their combined company at no expense to the fund. So now that you know a little about private equity, ask yourself, is private equity at fault for these large retailers going bankrupt? The answer is obvious. What incentives would they have for bringing down companies, defaulting on buyout debt, and ultimately losing the trust from their fund investors? There isn't. Private equity has no incentive to bring companies anywhere but upwards, and the strategy when purchasing those large retailers was to try to turn them around and bring them back to profitability. So, why did these companies go bankrupt? Former Toys R Us CEO Gerald Storch responded to Elizabeth Warren's comments by saying this.
Look, anyone who follows retail knows that the issue is the growth of the internet, e-commerce, and Amazon. That's what is killing these retailers.
Private equity is the unlikely villain in this case. Rather, convenient shopping and Amazon have made it hard for these retailers to survive. Thanks for watching. If you liked this video, make sure to give us a thumbs up.